Good morning and welcome back to Almus Market Mornings. Jay Powell gave the markets, especially those betting on rate cuts, something to cheer last Friday. He started the statement highlighting the shifting balance of risk in the Fed's dual mandate. Now, the dual mandate being inflation and price risk. He discussed tariffs, inflation risks, and also the review conducted on the monetary policy framework. Dollar weakened post the speech. Bond yields fell across the curve, though not a lot, and equities cheered. Good morning, JK. Welcome back to India. What is your take on the Jackson Hole symposium? Markets have shown a reaction, of course, but what's your take?
Yeah, good morning, Swaraj. Yes, of course, markets got what they wanted. Uh, so when he's saying that shifting of balance of risks may warrant adjusting our policy stance, clearly he's indicating that he's aligned with possibly a rate cut in September. But he seems obviously influenced by the very weak jobs report last month. And when the last Fed statement was made along with the FOMC decision. The job report was not available, so maybe it could have influenced then also. That is some one theory. However, if he has to wait more than the PPI inflation, which came much higher and also may filter into the retail, he could be seeing some further worsening in the job market. That is one, that's what I feel. Not just one number. Otherwise, a sudden shift in the stance would not occur. We still have the PCE inflation this week, CPI data next month before Fed meets. And if these numbers also come higher, it will be interesting to see how Fed reacts. And also, let's not forget that there are quite a few members in the Fed who still remain very cautious about a near-term rate cut. We had statement even after the Jackson Hole summit that Susan Collins said it's not a done deal that policymakers do at their coming meeting in September with risks to maximum employment and price stability roughly in balance. And one more member, Hammock, also said ongoing inflation worries suggest that monetary policy should not be changed. So I think it's not totally a done deal. It's a shifting stance by a kind of shifting stance by Powell, but it could still be hanging in balance. And for the market, I don't see this as a game changer. That sets a new trend of rising stocks or fall in yield or the dollar. For one, we have been talking about rate cuts expectation by the market. In fact, we had the expectation probability going up to 100% also for September, and now it's around 85%. So that's nothing new for the market. And also, if you see, let's look at it two way. If Powell is seeing a worsening job market even more, then it's not a good news for the market. Supposing Powell is wrong and the inflation comes higher, even that is going to be bad for the market. So I do not see what is the new thing that is driving the stock market recovery. I think it's just a matter of big knee-jerk reaction and maybe a relief rally for the market. I am not seeing it continuing at least immediately. As far as the dollar is concerned, yes, once again, we had a 1% move in the dollar index, euro rallying above 1.17. Once again, I'm not seeing it as a new trigger unless, some more data points justified a series of rate cuts and maybe two or three in the coming months. Or if, September happens to be a 50 basis points, that is the kind of scenario where we can see a much larger dollar, but otherwise I see this as a continuation of the range and also maybe consolidation in terms of time. Also for dollar not to lose much, you see the relative growth information from Eurozone. The German GDP growth last quarter came at minus 0.3% versus that is the final reading versus initial reading of minus 0.1%. So we all already indicated last week about a big fall in the US trade balance due to exports getting hurt. And one of the reasons was euro strength. So dollar weakness is also not as something, a new trigger and a big fall, unless, now maybe the next push by the administration, US administration, to get a weaker dollar will be uh, the bigger trigger if we have to look for much weaker dollar. Otherwise, I see this current ranges are to continue and perhaps even correction happening. Of course, as far as India is concerned, we have uh, not seen too much of a reaction in USD INR. We were trading at 87.50 towards the close on Friday, and we have been now trading at about 87.30, 35. We have our own global issues to contend with. The tariffs, 25%, and the additional tariff, which kicks in from 27th of this month. And in the absence of any progress in is the Ukraine Russia talks, and the two countries seem to be continuing to bomb each other. So that's not a good news. And so might well be seeing the 50% tariff in place from 27th. So that's not a good news as far as the rupee is concerned. The challenge continues. So the dips will be bought. Only thing is on the higher side, it can be arrested without too much of weakness, because there seems to be some big IPO issues or flows related to it in the pipeline, and some stake sale. So these could stop the rupee from breaking 88, but not much of gains is in store as far as Indian rupee is concerned. So overall dollar, I feel the ranges will continue even for the rupee. 87, 88 range is quite difficult to break. Of course, we will look forward to more data this week: US GDP, US PC, and then of course the consumption number. And of course, I think the next week's, that is August 5th, data on US employment for August will be key. If we get another very weak number, that's when probably it'll start the dice rolling towards the downside for the dollar. Thank you.
Thank you, JK. And I think the key takeaway would be that for dollar to weaken further, we did see some dollar weakness, but it was still within the range, as JK mentioned. But to see further weakness in dollar or a new trend emerging, what markets would be looking at, whether the Fed will go ahead with a series of rate cuts, and for that to happen, at least we need to see further weakness in job markets or the August NFP numbers to be sharply lower. So when all of these factors happen, or let's say suppose inflation comes in lower, surprising the market. So when all of these things happen, there may be much more expectations being built for a series of rate cuts, and that might actually lead to a fall in the dollar. When it comes to India, we have not seen much of a reaction in USD INR in the overnight markets, just 20 odd paisa lower. There is an absence of further continuation of talks between Russia and Ukraine, and there are no updates on the tariff front. But some inflows are expected to help cap rupee weakness. So we'll keep tracking that. That's it from us today. Thank you for listening. We'll catch up tomorrow with the fresh round of updates.